welcome to the show.
All right.
Here we are in the frozen tundra of Northern Virginia. I guess you could be in
Florida.
Pensacola.
Yeah.
That blew my mind.
It's been a crazy week.
Buddy of ours moved down to Pensacola area, sent us a picture, and I've never seen snow like that down there.
Yep, unbelievable. Yeah.
Wow.
Be interesting to see what happens with the orange futures.
Yeah, right? All that. Everything they grow down there. Hope it killed some alligators, though.
I know you don't like the alligators, do you?
Hope they froze to death. All right, what you got, man?
Oh, dude. Let's see. Actually, not a whole lot going on in terms of economic data this week, but a lot on the politics front, I guess. A whole bunch of inauguration was Monday. It seems like a long time ago. It was Monday. A whole slew of executive orders between then and now, and it'll be really interesting to see how all this rolls out. Probably from the financial media perspective, the biggest question is tariffs and whether or not they're inflationary. I saw a pretty interesting clip the other day. The way it was put out in the media is Trump demands interest rates to come down, which is pretty hysterical. I mean, you could argue that Jay Powell demanded interest rates come down when he started cutting the Fed funds rate, and the bond market said, "Yeah, I don't think so," and rates kept going up, right? So it'll be interesting to see what happens. So actually, in with respect to that, we had a request to take a look at kind of compare 45 and 47, right? Trump 45 and Trump 47. So what was the world looking like in terms of unemployment and inflation and all that when he took office in 2016 versus what it looks like now? So we shall have a look at all that, and then the TSP fund charts at the end, and then, of course, whatever happened this week. So Monday, markets are closed for Inauguration Day and Martin Luther King holiday. So on Tuesday, we had bond auctions, which are going to become pretty important going forward. But no significant economic data other than that. S&P was up 0.92% on Tuesday. And then Wednesday, mortgage rates came down a little bit from 7.09 last week to 7.02 this week. But applications pretty much were flat. They were up 0.1%, whereas last week they had exploded up 33.33%. So if you guys watched the show last week, we were talking about that quite a bit. The rates obviously have been going up, and last week they ticked over 7%, and so a whole bunch of people had new applications last week. It was up 33%. Because people have kind of thrown in the towel that, okay, rates are going up, so I better try to lock in now. But it kind of leveled off a little bit this week. So S&P was up about 0.5% on Wednesday. And then Thursday, initial jobless claims came in certainly higher than forecast. There were 223,000 this week versus 217,000 last week, and the forecast was for 219,000. So I want to take a look at a chart and just see how much what that really means. But S&P was up about 0.5% on Thursday. And so we've had an uptick the past few months in initial jobless claims, but it's really, even at this week, it's pretty much at the average. So while we're definitely on the lookout for unemployment going up, and this trend isn't great, but it's not that big a deal right now. It's not something that's super concerning. And then Friday, S&P Global PMI Composite, which is made up of manufacturing and services, and then also a whole bunch of home sales data is going to come out throughout the day on Friday, which could definitely swing the market. As of right now, it's about 11:30 in the morning and on Friday, and S&P is pretty much flat. It's down a little bit, but pretty much flat. All right, so Trump 45 versus 47. So this is what the stock market looked like during the first Trump administration. This was election. So the market had been moving higher, pops on election day, rallies quite a bit into the beginning of 2018, right? But then at the beginning of 2018, we had, almost a 12% drawdown, kind of early in 2018. Recover back up to just barely new highs, and then have a 20% drawdown into the end of 2018, right to right here. So 2018 was a rough year. This whole time period really was kind of rough, but 2018 was definitely a rough year. Get to the bottom in 2018, and then rally a good bit right before COVID, and then, of course, COVID was a 35% drawdown. So if you're looking at it over the course of those 4 years, certainly we went from the bottom left to the upper right. So the market went up. But in there, you got three separate, you got almost a 12%, a 20%, and a 35% drawdown over the course of that. So it certainly wasn't a smooth ride. Okay. Inflation. So rarely do you ever see inflation below zero. Below zero, inflation means deflation, right? Prices are actually going down instead of going up. So this is a line chart, obviously, but it's year-over-year inflation. So basically what that means is you take if you're doing it for 1 year, January through December, when the next January number comes in, you drop off the prior January and use that January. So it's a rolling year-over-year number. So the big difference in terms of inflation from where we were before, I mean, this is really low, right? This is the Fed's 2% target rate. So inflation was up here when in January 2017, when Trump first came in, inflation had been rising, but it was coming from, a really low place. So basically, the mindset of people, nobody was worried about inflation. And it wasn't that big a deal up here, right? Even though we're pretty much at the same level almost now where we were back in 2017 when he went into office the first time, the mindset here is much different than the mindset here because of this, right? Inflation, when inflation comes down, I mean, it was at 9% up here and came all the way down to 2.9%. But all that means is what used to cost, $100 back here, up here costs $110 because you had 10% inflation. Now that it's down to, say, 3%, if it cost you $100 here, it was $110 up here, it's $113 or so dollars here because it just keeps adding. It never goes away. It just keeps adding to what you're actually paying. So most of us that live in the normal economy, that when the Fed says, everything's great because inflation is coming down, that just means that the rate of the increase in the amount that you have to pay next year is less than it would have been. It's more. It's still more. It's just less than it would have been, and somehow that's a positive. But in terms of the mindset, you got people not worried about inflation going into the first Trump administration, and you got a lot of worries about inflation going into the second. Okay. And of course, the big question is this going to continue higher? Because we didn't, tariffs and deportations and a whole lot of things that are coming down the pike are potentially inflationary. Okay. And unemployment. So this is a big one. We talked about this chart quite a few times. The green are recessionary periods. And every time we get to a bottom and we start ticking up, it accelerates to the upside. And we got a recession, right? We got a bottom, accelerates up, we get a recession every time. In 2016, we had a recession, which is 2 consecutive quarters of negative GDP growth, but it did not correspond with rising unemployment, which is kind of a one-off. And then COVID, obviously, how they They said we didn't have a recession. I have no idea. But we had some huge unemployment, obviously because of COVID. But now we've come all the way back down, put in a bottom, and we're certainly trending back up. So the question is, does unemployment continue to accelerate to the upside and we get another recession in here? A lot of people are expecting that, and we'll see what happens. So, but in the first Trump administration, the trend in unemployment is clearly down, right? Nobody was worried about losing their job going into the first administration. And the trend is definitely up going into it now. So unemployment is definitely a worry relative to where it was before. And the 10-year Treasury yield. So this is probably the most important one. You could have gone back further because 89 wasn't the top in yield. It was actually back here in 82. But we had 40 years of lower highs, right, and lower lows. And so going into the first administration, we had put in a double bottom in yield right there. And it certainly looked like yields were going higher in the first administration, right? And it broke that downtrend line, which was pretty significant. And that's when the Fed taper tantrum actually happened, and the Fed started cutting rates, and so yields started coming down. And then once COVID happened, everything, they dropped yields in a hurry and started quantitative easing. So the first administration, there's a lot of economic stuff going on, but we definitely got to a low, an historic low in yield, which means it's a high for bond prices. And then as yields started going back up over the last few years, bond prices started coming down. And so the big question is where we are right now. This is 5%. If we get up here above 5%, people are going to freak out. Trump said this week he wants rates to come down. So if rates do come down, great. It's entirely possible. I was actually expecting rates to come down somewhere to 2%. So we would have this 1, 2, and then they start going higher. That was my sort of expectation for 24, and we didn't really get that. It's still in this, sort of consolidation, so we'll see what happens. But it's a very different interest rate environment that we're in right now going into the second Trump administration than we were back here at the beginning of his first. And the last one's the dollar. So this is what the dollar looked like from January 2017, so the beginning of the first administration, and this is obviously where we are now. So when the dollar goes down, it's a positive for stocks. It doesn't mean on a day-to-day basis when the dollar goes down, stocks go up, but it's definitely a positive for stocks when the dollar's going down. 2018, right, the dollar was going up. It was a very tough year for the market in general. And then after COVID, the dollar started falling, and we had that big recovery rally. And then dollar starts rising into 22, and we have that bear market. So what's really interesting about the dollar right now, and it's the big question, is this a peak? Because we came into it at a peak in the dollar. Came into it when he started the first administration, there was a peak in the dollar. So if the dollar starts coming down from here, stocks should go up. If the dollar keeps rising, stocks are going to continue to be under pressure. And then that's what it looks like if you put the S&P 500 on top of it. So at the beginning of his first administration, the dollar falls, right? Stocks go up. 2018, it's a really choppy year. The dollar was going up over that time period, right? Dollar goes down, stocks go up. Dollar goes up, stocks go down. This is really strange. Dollar up, stocks up. It doesn't happen very often. And one of two things happen because of that, right? Either the dollar keeps going up and stocks roll over. That's one possibility. The other possibility is that the dollar rolls over and stocks keep going up, because that's it usually has an inverse correlation. So it's going to, I mean, it's nobody knows what's going to happen, right? The dollar, if it rolls over, it's good for stocks. So if the dollar rolls over from here, stocks should keep moving higher. Okay. So that's kind of how the world looked, at the beginning of his first administration and how we're looking now. Things are quite a bit different. Rates are different, yields are different. The dollar is kind of the same. It's going to be interesting to see how that goes. But there aren't a whole lot of similarities. The biggest thing is yield. I mean, that's really the biggest thing.
Yeah, and it's so rare to have. I don't even remember the last time this happened. But to have a president skip 4 years, right? So coming into a very different economic situation than you did the first time, because it's usually that person for 8 years. So that's right. Our recent past. That's what's happened. Right. It's been that person, and you could easily blame everything on that person, right. Good or bad, right? It's kind of hard to do right now because those administrations have shifted, back and forth for the last. This is going to be 12 years. Yeah. So, I tend to think that's why there's a lot more of these kind of divergences or whatever. Like, normally it does X, Y, and Z, and it's not doing that right now because these administrations haven't been able to do whatever it is their policy, movement is for economics, and that usually keeps that trend going, good or bad again. That hasn't been able to happen, right? I think you can make a lot of arguments that we've been very distracted by other things, Ukraine war and sure. Whatever, getting out of Afghanistan. Like, you mix all of that in these economic decisions. It doesn't surprise me that you have these oddities right now, these things that are just a little bit outside of the norm. And the reason I bring that up is, does it start to go back to normal right. because we keep this? But it's not. He's not going to have another administration, right? Or he won't, right? The Republicans may stay in, but so all that's very interesting to me. Is that this kind of in and out every 4 years of different kind of policy agendas has to be having an impact on these things, and so maybe that's why the trends aren't lining up the way you would think they are normally. Maybe, yeah. Who knows? I mean, that and the addition of a whole lot of debt.
Over the last. I mean, debt just keeps going. It's if the policies that he puts in place decrease the amount of government spending, that's generally looked at as a good thing, right? It's good for the economy and all that. It's going to be bad for the stock market if that happens. I don't have the chart, but you can definitely show the correlation between the rise in the stock market and the rise in deficit spending.
Right. Is it necessarily government spending or deficit spending? Does it matter if it's a spending and deficit, or is it you see what I'm saying?
Yeah. Well, see, when rates go up, it's harder for companies to spend to borrow, right? Yeah. So the government is filling that void, and so if the government stops or decreases the amount of deficit spending, it's just less money in the system to go to financial assets. So it'll be looked at as a positive. It'll be spun as a positive for the market, for the economy, and it's super important. It's the only way you're going to get the debt under control.
I guess what I'm saying is, like, let's say and this is all theory, obviously, because nobody's been able to do it, but you could potentially lower the deficit, not be spending in a deficit, and still spend more. What you're doing is just getting rid of things you were spending money on that you didn't need to spend money on, right? It's just like your account at home, right? You could lower, your discretionary outgoing, right, but still spend more without being in a deficit. So that's what I'm kind of getting at is it that the government? I do get the correlation between, if the government is spending a lot of money, it's good for companies, right? Because that's where they're spending it on. Yeah. Like, generally speaking, but they may be funding state things or whatever, but a lot of times it's funding companies. Yep. And so if government spending in itself, whether it's deficit or not, if that goes down, I see the correlation. That's just kind of where I was trying to make the distinction in case someone kind of missed that point, because at the end of the day, as long as they keep spending, that's good for the economy or good for companies.
Yeah.
That's it. How they're spending is not really as relevant as the fact that they need to spend money. Now, if they're hoarding money, right, not spending it, that's going to be bad for companies.
Yes.
Yeah.
I mean, people would argue it's good for the economy. It's good for the sustainability of
the government.
Yeah. But in the short run, because that's what they keep saying, you know, you can't. You kind of can't have your cake and eat it too.
It both ways.
You can't have it both ways.
Yeah, we've just, I think, you know, again, this is obviously opinion and not backed by facts, but it's just observations over being in the government for 30 years. But you know, we have just spent a lot of money on things we didn't need to spend money on. I mean, you know, I saw it overseas, right? I've been there as a civilian federal employee and as also a military employee, you know, a service member, and the amount of money we would just burn through was ridiculous.
Yep.
And so that probably didn't need to happen, and that contributed to a lot of it. I mean, just billions, right? So anyway, you can't go backwards; you can only go forwards. And I just, you know, for all the people that complain about, you know, the deficit rising, they just need to keep this in mind. You know, if the government stops spending money, don't expect your you know, your investments to go up.
Yeah, that's the catch-22, right?
Yeah.
All right, TSP Fund Charts. So this is through Thursday. Weekly chart, right? Each tick on the chart is 1 week of price movement. The blue line is the 20-week moving average line and the relative strength indicator down here. So if you're following on a weekly basis, this was the top in 2022. Once we get below that 20-week moving average line, you don't want to be in the stock funds or the C fund anyway when you're below that 20-week moving average line. It's obviously there are some fake outs here, but for the most part, price, as long as it stays below that downsloping 20-week moving average line, price is going lower. And then once it gets above that line, you're back in good shape. This was the breakout to the upside in October, November of 23. And every time it's pulled back, it's found support at that 20-week moving average line and keeps on making new highs. And as of Thursday this week, we have our first new all-time high for 2025. So if you're looking at it on a weekly basis, there you are. A little bit concerning is that this high in December, the relative strength is up here about 70, and we're pretty significantly off that as we get another new high this week. But again, that divergence is a condition. It's not a timing tool. It's absolutely possible that S&P keeps going higher and relative strength keeps going up, gets above 70, gets overbought, and price keeps on going. That's a possibility. Okay, S fund. Same kind of thing. It's quite a bit more volatile than the C fund, but that 20-week moving average line obviously provides a pretty good guide for support, right? And that 50 RSI line. So as long as we're above the 20-week moving average line in price and we're above 50 RSI, right, the market keeps moving higher. It's when we're below the 20-week and relative strength gets below 50, right, that the market has problems. So that's why we use those. It's not a crystal ball. It's not foretelling anything. But we know that when RSI is below 50, there's a lot of weakness in the market. And when price is below the 20-week moving average line, it tends to go down from there. So that's their guidelines, right? There's no guarantee. There's no silver bullet. iFund has been, really weak since where we are here, October of last year. It got below that 20-week moving average line, popped above it a little bit back in November, December, came down to new lower lows. And then this week, looks like we're going to close back above the 20-week and just barely above 50 RSI. So this is certainly the beginning. This is a condition where the I fund could continue higher, right? Especially if the dollar goes down. That's really the thing for the I fund. If you're looking at reallocating to the I fund, the dollar has been rising for quite a while, and so if the dollar rolls over and starts going down, the I fund is definitely going up, and it's already in a good position to do that, right? Because it's already above. We sort of already have a buy trigger on a weekly basis for the I fund. And the F fund, still, it's the big question mark because it corresponds to interest rates. And so it looks like we put in a little bit of a bottom over the last couple of weeks. Not a great week. Certainly this week is not above its 20-week moving average line. RSI is still below 50. So if yield, goes higher, the price of the F fund goes down. So we shall see. The F fund is still not looking like a great place to be right now. And the G fund keeps on going up and to the right. So if you are concerned about all the craziness that's going on, to be in the G fund and get, 4.5% guaranteed rate of return is not a bad plan. And if you listen to anybody in the mainstream financial media that are bond guys, they are loving a 4.5 to 5%, bond yield. It's guaranteed. Like you're not gonna, if you buy the bond and you hold it, you're not gonna lose money on it. And so, yes, you don't get if you think we're going to get another 20% year in the stock funds, then be in the stock funds. If you're worried about it,
right, you're not losing money. You might be losing opportunity.
Right,
you're not losing money.
No, you're certainly not. You're gain. A 4.5 to 5% gain. That's what you have to weigh. What do I want to be in the stock funds? I think we're going to get another 20% year in the stock funds, right? If that's your base case, okay. How sure are you compared to a guaranteed 4 to 5% gain? So maybe you take that thought process and do a 50-50 C and G. I don't know. There's all kinds of ways based on your circumstances and risk tolerance to kind of think through if you want to do a kind of a long-term allocation through 2025 and you don't want to manage the ups and downs and all this, then that's a way to do it. You're guaranteed to have gains in whatever portion you put in the G fund. And as rates go higher, those gains go up. So that's all I got. Questions?
As usual, if you have any questions, put them in the comment section wherever you found the video. And if there's no comment section, shoot us an email, support@growmytsp.com. If you like the show, please share it with your friends. If you don't, share it anyway.
Share away.
We'll talk to you guys later, and I hope you're having a good weekend. And I really hope the Commanders won by the time this comes out. See you guys.
Yeah, I'm sure you do.